Welcome to today's market report.
The dollar firmed and global equity markets fell on Friday as rising interest rates unsettled investors amid a growing chorus of central bank officials insisting monetary policy needs to remain tight for some time to lick inflation. US mega-cap growth companies came under pressure, and shares of ride-hailing firm Lyft Inc. tumbled 36% after a downbeat forecast. In Europe, a Dow outlook by Adidas added to the downbeat mood that higher interest rates gave investors. A sell-off in government debt set the day's tone. The yield on benchmark 10-year Treasury notes hit a more than 1 month high, and the 10-year German bond posted its biggest weekly rise this year as European Central Bank policymakers warned about inflation. Yields move opposite their price. MSCI's US Central Index of Stock Market Performance in 47 countries shed 0.34%, while the dollar index rose 0.37%. Stocks on Wall Street ended mixed as many investors held out hope for a rate cut later this year, and rising oil prices lifted energy shares. The economy, earnings, and potentially the labour market won't look so good as this year wears on and maybe into next year. That doesn't necessarily translate into market losses. Broad disinflation has yet to start, even if overall price growth has been in quick decline, according to ECB board member Isabel Schnabel, the latest Eurozone policymaker to say rates must rise further to combat inflation. Fed officials said the same all week, as did policymakers in Australia, Sweden, and Mexico, as they too raised rates. The Dow Jones rose 0.5%, the S&P 500 gained 0.22%, and the Nasdaq dropped 0.61%. The Pan-European Stock 600 index fell 0.96%. Cable is at 120, Euro dollar is at 106. This is today's market report. Thanks for listening. We'll see you next time.